Hi everyone, and welcome back to the channel. Stock options come with a lot of risk, and I personally don't think most casual investors should be implementing them as part of their investing strategy. However, it is important to be educated on how they work and determine if it is a strategy that could work for you. So let's get into it. There are two types of stock options: call options and put options. Call options are purchased when you expect the underlying position to increase in value. They're actually a bullish strategy. Put options, on the other hand, are purchased when you expect the underlying position to fall in value. They're a bearish strategy. So what even is an option? An option gives the person who purchased it the right to buy or sell stock, specifically 100 shares, at a chosen price before or at a chosen expiration date. If this sounds a bit confusing, don't worry. I'm going to break it all down for you one piece at a time. One component of an option is its strike price. This is a predetermined price chosen when purchasing the option that determines the dollar value at which the option can be exercised. Exercising an option means to either buy or sell the underlying shares, but don't get caught up in that yet. With call options, while you're holding onto that option, you're hoping that the value of the chosen stock will increase over your strike price. For put options, you're hoping that the value will fall below your strike price. Buying an option where the underlying stock value is below the strike price for calls or above the strike price for puts is called buying out of the money. Buying an option where the stock value is above the strike price for calls or below for puts is called buying in the money, but we'll have more on that later. The second important component of any stock option is its expiration date. This is simply a date that represents the last day that the option may be exercised. If your option has not gone in the money by the time this date comes around, it will expire worthless. If it is in the money though, it will likely be automatically exercised if you don't already choose to exercise it yourself, but this completely depends on your brokerage. Purchasing options with expiration dates that are much closer is generally cheaper, but far more risky. You can also choose to purchase expiration dates that are much further out, and they'll be less risky, but they will cost a good bit more. Finally, there's the price you pay for the option, and that's called the premium. This premium is a little different than owning shares, which have a long-term value. The premium is a mix of how far in the money the option is, how far away the expiration of the specific option is, and finally, how volatile the stock is, or how investors might be feeling the stock will go in the future. That could be up or down. How this price fluctuates can be very complicated. Keep in mind when purchasing options that because of the nature of the expiration date, if the stock moves in the wrong direction, you can lose the entire value of that option and all of the money you paid for it. This is certainly different from stocks, which don't have an expiration date and therefore have much less risk. So that might have been a little overwhelming. Let's take a look at an example so we can understand how all of these pieces work together. Let's say that you're looking at a company and it's called ABC Inc. Their share price is $100 per share and you expect the stock price to go up in the next month. Because you have a bullish attitude about the stock, you're going to want to buy a call option. You explore the option chain and you see the following option. Let's take a look at the pieces together. ABC is the underlying stock for ABC Inc. April 21st, 2023 is the expiration date. Let's pretend that that's 1 month away, as I don't know when you're going to be watching this video. 103.00 is the strike price of the call. This is the price that you're hoping the shares will move above before the end of the month. The call part means that it's going to be a call option that you're purchasing. The add 1.80 means that the price per underlying share is $1.80. And since options represent 100 shares, this option will have a $180 premium. That sounds like a lot of money for something that expires in just a month. And you're right, it is a lot of risk. But here's where options start to get very interesting. If you wanted to buy 100 shares of ABC Inc., it would cost you $10,000 because it cost $100 per share. So if you had $10,000, maybe this is the safe route for you. However, buying this call option only costs $180, and it gives you the same leverage that 100 shares does, but with a catch. You need the underlying shares to go up in value, and you need it to happen before your chosen expiration date. Let's imagine just a few scenarios. ABC Inc. goes up to $110 per share, which is a huge month. If it is now the end of the month, your option, which had a strike price of $103, is a whole $7 in the money. That means at expiration, your option is worth $700. Essentially, your option gives you the privilege to buy 100 shares of ABC Inc. at the price of $103 per share, even though the stock is now worth $110 per share. If that sounds confusing, just keep in mind you can sell the option for its value instead of thinking about the underlying shares. This is an example of how much leverage an option can give you. In 1 month, you turned $180 into $700. Okay, now let's look at a situation where you get a more modest return. ABC Inc. goes up to $105 per share, which is still pretty good growth. Your option had a strike price of $103, so it is now $2 in the money, and still worth $200 at expiration. You turned your $180 into $200, but you were actually very close to taking a loss as well. In fact, 20 cents away from you losing money. And now, unfortunately, we need to look at a bad situation. ABC Inc. only goes up to $102 per share, and that is some growth, but it's not enough. Your option had a strike price of $103, which is $1 above the actual share price. It is not in the money. Because the expiration date has come, your option is now worthless. And with that, you've lost your entire $180, which is where it's easy to see the risk. Keep in mind that you still lost all of your money even though the stock went up. It just didn't go up enough. And this same situation could happen at any price below $103, since that would be below your strike price. These examples show just how much power an option can give you, and the leverage of 100 shares at a much lower price. But the money you spend is much more at risk than if you just own the shares yourself. Keep in mind, all of the examples above are explaining a call option, where you reserve the right to buy shares at a chosen strike price. For a put, you have the right to sell shares at a certain price, so everything is reversed. You want the stock to go down below your strike price, so that way you can sell shares at a higher price than they're actually worth. It works exactly the opposite as a call. One more caveat. For most normal options, you can sell the option at any point for whatever its current price is. Let's say ABC Inc. immediately went up to $103 a few days after you purchased the call option. Because it is still so far away from expiration, has good sentiment, and just became in the money, your option will be rapidly increasing in value. It could easily be worth $350 just a few days after you purchased it, and you could sell that for a profit without holding on to it for the rest of the month. Someone else is purchasing the option off of you. Now you have made your profit and are no longer holding a risky position until the end of the month. I also touched on this briefly above, but expiration dates can either be very close and risky or further out and less risky, though the premium will be much higher if the options are further out. If you trust that a company is actually going to grow over the next year or so, but you just don't know when, sometimes it makes sense to actually buy a call option with an expiration date a year out or even further. This offers high leverage without being at a big risk of buying the option and it expiring at the end of the month or even at the end of the current week. But please be aware, all options are risky, even if the expiration is very far away. If you have any questions or comments, feel free to leave them below. Also, if you enjoyed an animated video like this, please make sure you like the video and consider subscribing to the channel. Otherwise, I'll catch you in the next one.